Ladies and gentlemen, gather around and prepare to embark on an unforgettable journey into the exhilarating world of stocks and financial wizardry. Welcome to Stock Marketpedia, where the stock market meets showtime. Let's kickstart this electrifying adventure together and redefine what it means to be the stock market superstar. So without further ado, hit that play button, fasten your seatbelts, and let the financial extravaganza begin. Get ready for a wild ride because Stock Marketpedia is here to rock your world. When Warren Buffett embarked on his investment journey at the young age of 25, he established his first investment firm, Buffett Partnership, in 1957. This partnership remained in operation until 1969, and during its tenure, Buffett achieved an extraordinary average return of 29.5%. What truly sets Buffett apart from other investors is his ability to generate remarkable returns using simple and rational investment strategies, eschewing the need for complex methods. He firmly believes that investing does not require exceptional intelligence. Instead, it demands rationality. The key to achieving high returns lies in adhering to rational principles and steadfastly following simple strategies even in challenging times. In this video, we will delve into 7 investing rules inspired by Warren Buffett, which, when implemented, have the potential to significantly enhance long-term investment performance. However, it's important to acknowledge that while these rules can prove valuable, it's unrealistic to expect returns on par with Buffett given his vast experience and wisdom. Nevertheless, by incorporating these rules into your investment approach, you can substantially improve your overall investment outcomes. Rule number 7, business success equals stock success. Warren Buffett, a renowned investor, learned a crucial lesson early in his career from the influential book The Intelligent Investor, authored by his mentor Benjamin Graham. This rule serves as a cornerstone of Buffett's investing philosophy, centering around the simple yet powerful concept that owning a stock signifies owning a slice of a business. According to Buffett, if a business prospers and flourishes over the long haul, its stock will inevitably reflect the success. Embracing this rule necessitates the astute identification of companies positioned to dominate their respective industries. Such businesses possess certain key attributes that contribute to their long-term success. High profit margins serve as a crucial indicator of a company's ability to generate substantial returns on its operations. Furthermore, a competitive edge enables a business to distinguish itself from its peers and secure a sustainable advantage in the market. An extensive and loyal customer base not only validates the quality of a company's products or services, but also fosters the potential for ongoing growth and profitability. Understanding that a stock represents ownership in a business is essential to internalize the significance of this rule. The performance of the underlying business directly influences the performance of its associated stock. When the business thrives, the stock tends to follow suit, providing investors with the opportunity to reap the rewards of their investment. By adhering to this rule, investors can align themselves with the intrinsic value of a business. Instead of succumbing to short-term market fluctuations or speculative trends, they focus on businesses with strong fundamentals and long-term growth potential. While duplicating Buffett's exceptional returns may prove challenging, embracing this principle can lead to a more prudent and value-driven investment approach. Rule number 6, plan to hold stocks forever. The power of compounding cannot be overstated. When investors allow dividends and capital gains to compound over time, they stand to benefit greatly. Constantly buying and selling stocks undermines the potential of compound interest and may lead to missed opportunities. Timing the market is a risky endeavor. Buffett advocates for a long-term approach, suggesting that when investors purchase a stock, they should plan to hold it indefinitely. Buffett himself has held stocks such as Coca-Cola, Wells Fargo, and American Express for over 25 years. Echoing the words of renowned investor Phil Fisher, if a stock is purchased with thorough analysis, the need to sell it should rise infrequently. Rule number 5, be fearful when others are greedy, and greedy when others are fearful. This rule holds particular relevance in today's market conditions. Over the past 11 years, we've experienced a prolonged bull market, with stock prices soaring by over 300%. As a result, many investors have become overconfident and driven by greed, assuming their investment prowess is infallible. Consequently, stock prices have become inflated, making it increasingly challenging to find value in the market. In such times, it's crucial to exercise caution and be mindful of the potential risks. Buffett exemplifies this approach by holding a significant amount of cash, $295 billion in publicly traded stocks and $129 billion in cash. He adopts a cautious strategy, remaining patient and selective in his investments. While others succumb to greed, Buffett's disciplined approach positions him to capitalize on market downturns when fear sets in. By following this principle, investors can avoid market exuberance and capitalize on opportunities during periods of market pessimism. Rule number 4, Understand what you're investing in risk arises from ignorance. While seemingly simple, this rule is often overlooked by many investors. Buffett's portfolio predominantly consists of companies with straightforward business models. For instance, Coca-Cola sells beverages, Southwest Airlines operates in the airline industry, and Apple manufactures and sells technology products. Buffett ensures that he comprehends the businesses he invests in. Similarly, investors should strive to understand the companies they invest in, conducting thorough research and analysis. Whether it's the automotive sector with companies like Ford, Toyota, and Tesla, or the e-commerce industry with Amazon and Alibaba, diving deeper into the industries and companies we're familiar with empowers us to make informed investment decisions. Remember, investing in what you understand mitigates risks associated with ignorance. Rule number 3. Listen only to those you know and trust. Investing is not a solitary endeavor, even for someone as accomplished as Warren Buffett. Throughout his career, he has consistently sought to learn from and listen to other investors. During his formative years, he received guidance from Benjamin Graham, his mentor, and in later years, Charlie Munger became his trusted confidant and sounding board for investment decisions. As individual investors, we too have access to great minds such as Buffett, Ray Dalio, and Charlie Munger, whose insights can inform our own investment strategies. It's crucial to discern whom we should listen to, disregarding self-promoting individuals who lack genuine expertise. Instead, we should seek guidance from reputable investors who have a track record of success and a deep understanding of the intricacies of investing. By listening only to those we know and trust, we can benefit from their wisdom and insights, aligning our investment decisions with proven strategies. Rule number 2. Ignore the noise, focus on the facts. News isn't always helpful. Warren Buffett has a unique perspective on consuming news when it comes to making investment decisions. He believes that the vast majority of news related to investing is not only unnecessary, but also distracting and misleading. Whether it's news programs on TV, financial websites, or popular YouTubers, their main goal is to attract as many viewers as possible. This often leads to an overload of sensationalized information that creates more noise than substance. Buffett suggests that investors should only pay attention to about 5% of the news they come across. Why? Because most of the chatter revolves around short-term market trends, economic predictions, and the daily ups and downs of stock prices. These things can be unpredictable and highly influenced by emotions and speculations, making them unreliable guides for long-term investment decisions. Instead of getting caught up in the noise, Buffett advises focusing on the essential and relevant information. By filtering out the noise, investors can concentrate on the facts that truly matter. This means understanding the fundamental aspects of the companies that they're interested in, analyzing their competitive advantages, financial health, and long-term growth potential. By adopting a rational and informed approach, investors can sidestep the traps of following the latest news and pundits' opinions. Buffett emphasizes that the key to successful investing lies in understanding the businesses you invest in, rather than being swayed by short-term market noise. By doing thorough research and maintaining a rational mindset, investors can make more informed and grounded decisions based on solid facts, rather than being influenced by the noise generated by media outlets. Remember, investing is about the long term. By focusing on the important details and disregarding the noise, you can develop a clearer understanding of the companies you invest in and make more sound investment choices. Rule number 1. Purchase stocks below their intrinsic value. This rule is the bedrock of successful investing. Disregarding this principle renders the other rules ineffective. Regardless of a company's excellence, its management team's capabilities, or your understanding of the business, no stock is worth an infinite price. It's imperative to purchase stocks at a price below or equal to their intrinsic value. As Buffett aptly states, price is what you pay, value is what you get. To determine the intrinsic value of the stock, one must learn how to assess and calculate it accurately. Investing courses such as the one offered by Sven Carlin can provide comprehensive guidance on investing principles, including valuing stocks and determining their intrinsic value. Carlin's course and research platform offer valuable insights into achieving high long-term returns. Adhering to this rule ensures that investors make informed decisions based on the true value of the stocks they purchase. By embracing these 7 essential investing rules, investors can set themselves apart from the majority and enhance their chances of success. Adopting the mindset that stocks represent ownership in businesses, filtering out noise-driven news, committing to long-term investments, listening to trusted and knowledgeable voices, understanding the companies in which you invest, remaining cautious amidst market exuberance, and purchasing stocks below their intrinsic value can significantly impact investment outcomes. While attaining returns on par with Warren Buffett may be unrealistic, embodying his rational and disciplined approach to investing can pave the way for improved long-term returns and a successful investment journey. That's a wrap for today's video, but the excitement doesn't stop here. Get ready for more mind-blowing content coming your way. We'll be pumping out videos 3 to 5 times per week, so buckle up for an exhilarating ride. Drop your comments below with your topic requests because we want to hear from you. And don't forget to smash that like button, subscribe, and hit that notification bell to stay in the loop. Stay tuned for the next thrilling episode on Stock Marketpedia, where we make stocks sizzle.